You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the deep dive. This week, global markets are facing a pretty unique challenge, a classic one, really. They're being forced to parse politics just as much as prices. Our focus today, it's the world's reaction to this persistent U.S. government shutdown.
Right. And it's not just a D.C. issue, is it?
Not at all.
Yeah.
This creates a massive information vacuum, and that ripples across, pretty much every asset class, everywhere. So our mission in this deep dive is basically to be your analytical shortcut. We're trying to extract the really high weight signals, the key market drivers, from what's become a severely narrowed information set.
Yeah, because the U.S. government, it's temporarily paused those critical economic releases.
Yeah.
The hard data markets usually rely on.
Exactly. So traders are, effectively flying blind compared to usual.
Yeah.
We need to figure out precisely what volatile high weight indicators they're leaning on now that the lights are sort of out on official data.
And that really is the core challenge for you, the listener. Think of official U.S. data, your jobs report, inflation figures. That's usually the bedrock, right? For global economic visibility, with that temporarily gone, policy visibility is just drastically reduced. We can't anchor expectations like we normally would.
So what fills the gap?
It shifts the weight almost entirely onto high-frequency central bank communications, political signals, and private sector indicators, too. It just creates a much thinner backdrop for making high-conviction decisions.
Which means more volatility.
It definitely increases the volatility of reaction to any single headline. Much jumpier market.
Okay, let's unpack this immediately then. If you're a trader looking at currency markets right now, how on earth do you manage your positions when you can't verify the strength of the world's biggest economy? What becomes your new anchor when, the jobs report just isn't showing up?
Well, the immediate impact, you can see it in the dollar, the USD. What's really fascinating here is that the dollar has actually eased modestly. The lack of consistent, reliable U.S. data, it's directly reduced market conviction on the Fed's future policy path.
How so?
Well, without that confirmation of domestic economic strength, the market just can't price in aggressive interest rate hikes with the same certainty as before. That conviction fades and the dollar softens.
So the absence of data itself almost acts as a dovish signal for the dollar, even if the underlying economy might still be strong.
Precisely. That's a classic information vacuum response. Spot on.
Interesting.
And if you connect that uncertainty globally, especially in other key currencies, you start to see some divergence.
Okay, like where?
Take the Japanese yen, the JPY. It remains highly defensive at the margin.
Why is that?
Because, the shutdown noise hasn't really changed the fundamental divergence there. We're still hearing remarks from Bank of Japan officials, the BOJ, emphasizing their, persistent need to maintain an accommodative stance.
Still trying to support their own economy.
Exactly. They're committed to stimulus, pretty much regardless of the Fed's current data visibility issues. And that keeps the yen weak.
That sets up a really fascinating contrast when we look down under, right? The New Zealand dollar, the NZD, heard it's highly sensitive right now.
Very much so. They're heading toward an imminent Reserve Bank of New Zealand decision, the RBNZ. And markets see it as a live debate over the size and speed of further easing.
A live debate? Why is it carrying so much extra weight this time?
This is a perfect example of a signal carrying extra weight in this thin environment. Normally, the RBNZ decision would be digested alongside concrete U.S. CPI or payrolls data.
Right, you'd have context. Yeah.
Now, the RBNZ is one of the few high-conviction global signals actually available. The debate is live because the market is split. Will they ease by the expected 25 basis points?
Or go bigger.
Exactly. Feeling pressure maybe from reduced global growth visibility, the uncertain outlook. Will they opt for a more aggressive 50 basis points? That larger move would signal a real lack of confidence.
And that's why the NZD is so reactive.
Totally. The market's basically looking to Auckland for the kind of global policy clarity that Washington isn't providing right now.
So, in essence, the RBNZ decision becomes almost a surrogate for global risk assessment this week.
It absolutely does. Now, contrast that with, say, the euro and sterling, EUR and GBP. Their story is far steadier.
Okay.
We've seen mixed but broadly stable services readings from Europe and the UK. Their big domestic service sectors seem to be holding up, more or less.
So they're less affected by the U.S. data void.
Well, it means both currencies are primarily taking their cue from the dollar's drift.
Yeah.
They're reactive to USD weakness and, whatever fragments of U.S. survey data trickle out.
Yeah.
But they aren't driving the currency narrative themselves.
They're just waiting.
Pretty much standing still, waiting for the political clouds over the U.S. to clear.
Right. Speaking of assets that sometimes thrive on uncertainty, the liquidity that stepped away from the dollar, it didn't just vanish, did it?
No, definitely not.
A lot of it seems to have flowed straight into the commodities space. And this is where it gets really interesting, I think, in terms of asset behavior during a fiscal impasse like this.
Absolutely. Because commodities are trading this mix of pure fundamentals and, well, immediate political risk.
Where do we start? Gold?
We have to start with gold. It's the classic portfolio insurance asset, isn't it?
Mm-hmm.
And gold remains elevated after a pretty strong run. Now, this is partly a direct consequence of the softer dollar we just talked about.
Makes it cheaper in other currencies.
Right. But more importantly, it's driven by this persistent demand for insurance while Washington's fiscal impasse plays out. When the political environment feels fragile, big investors hedge. They hold gold.
And we're seeing evidence of that.
Yeah, we're seeing it manifest not just in the price, but in concrete data. Continued net inflows into gold ETFs, for example. Increased speculative positioning in futures markets. It signals that long-term risk aversion is pretty dominant right now.
Okay, but it's not just safe havens moving, is it? Base metals, which are often seen as proxies for global manufacturing health, they're showing surprising resilience. Copper, for instance, has firmed up.
It has.
Why would an industrial metal be firming when the data picture is so murky, especially out of the U.S.?
That strength is a powerful signal. It's driven partly by ongoing supply concerns. Those are structural, they've been around, but also by surprisingly resilient risk appetite, specifically in Asia.
Ah, interesting. Even with China's holiday disruptions.
Yeah, even as China's onshore markets are working through those holiday breaks, high-frequency data, particularly some of the regional manufacturing PMI readings, they're holding up better than expected.
So what's that telling us?
It suggests that genuine underlying demand, particularly maybe from China's infrastructure push, green energy sectors, is overriding the information deficit from the U.S. They seem to be betting on the physical reality of demand, not the temporary U.S. political noise.
Fascinating. Then we get to oil, crude oil, which seems to be sitting in this perpetually fragile equilibrium, leading to incredibly choppy trade. What exactly makes up this equilibrium?
It's defined by these conflicting signals that kind of neutralize each other, and that makes the market highly sensitive to the last piece of news that hit the wires.
Like what kind of signals?
Well, we've had talk of, modest OPEC plus quota changes, but then that gets sharply tempered by official pushback on reports of larger increases that might flood the market.
Right, so uncertainty about supply levels.
Exactly. And at the same time, you have intermittent outage and export headlines cropping up elsewhere, geopolitical constraints in key producing regions that constantly complicate the supply-demand balance. It's always shifting.
So the net result is...
What? Extreme sensitivity.
The net result is an energy market that is just disproportionately responsive to incremental news. A single headline about, say, confirmed resumed flows from a previously constrained pipeline, or maybe new producer guidance on output. It gets oversized attention.
In this environment, stability is kind of deceptive. The market feels wound tight, just waiting for a definitive supply shock or perhaps a political one.
Okay, let's pivot then. Let's move away from central banks and standard economic indicators for a moment and turn to those other policy signals, trade and geopolitics.
Yeah, good idea.
Because with the economic signals muted by the shutdown, these politically charged headlines, they seem to be disproportionately shaping the overall market tone now and the risk premiums.
They really are punching above their weight right now.
And we've got a really unusual, quite fascinating linkage regarding tariffs coming out of the White House that markets are watching very closely.
Yes, the rebates idea.
The administration has floated this idea of giving taxpayer rebates, potentially, $1,000 to $2,000 per person. And the critical link here is that these rebates would be explicitly funded by tariff revenues.
Which is, well, it's a monumental shift in political calculus, isn't it?
How so?
Markets are intensely watching the details and timelines of this idea because it fundamentally weaponizes trade policy for domestic fiscal relief. It essentially ties trade wars, which are traditionally about international negotiation, directly to domestic spending.
So it guarantees tariffs remain a political tool.
Pretty much guarantees it, yeah. Irrespective of global trade negotiations.
Yeah.
It just raises the probability of sustained high tariff levels going forward.
And globally, that whole tariff landscape is already hyperactive, isn't it?
Oh, absolutely. We've just seen China open a trade barrier probe into Mexico's tariff regime. And they've signaled quite clearly they're prepared to take steps to defend the interests of Chinese firms there.
Okay, so if we connect this to the bigger picture, why should you, the listener, care so intensely about these specific tariff moves right now?
Because they're inflationary. Simple as that. Tariffs ripple through import costs, they squeeze corporate margins, and by extension, they directly impact the very price dynamics inflation that central banks are obsessing over.
So every new tariff barrier, whether it's U.S.-China or China-Mexico.
It's effectively a policy driver that substitutes for the missing hard data on consumer prices.
Right.
It's feeding into that inflation picture central banks watch.
Exactly. And speaking of persistent drivers, geopolitical risks seem to be keeping an elevated security concern baked into various markets.
That's certainly true.
In the Middle East, for example, Hamas has apparently told mediators it needs more time, seeking changes to elements of the U.S. plan for Gaza.
Right, which keeps that diplomatic track fragile. It prevents the removal of any existing risk premium in, say, regional energy flows. The uncertainty persists.
And we're seeing these constant, sometimes stark reminders of security risks elsewhere, too. Germany's Munich airport, a major European hub, briefly closed overnight. Why? Drone sightings.
Yeah, and that isn't just a simple travel delay for passengers. For markets, it's a clear reminder of how security incidents can directly disrupt high-volume transport and logistics.
Forcing higher costs.
Exactly. Forcing freight companies to continually price in higher insurance, higher security costs. It becomes embedded.
And crucially, we can't forget the Russia-Ukraine situation. Discussion of maritime risks, long-range strike risks, that continues among officials, doesn't it?
It does, and that's key because even when the frontline headlines maybe quiet down for a bit, that ongoing discussion keeps a sustained elevated cost baked into energy and related freight channels, particularly in places like the Black Sea.
So you're saying it's not really a latent risk premium anymore, it's almost structural?
I'd argue it's becoming a structural cost of operation now, yes.
Okay, so let's synthesize this, let's pull it together. What does all this mean for today's market tone right now?
Well, with that crucial U.S. data calendar effectively curtailed, the market tone is going to be shaped disproportionately by, I think, 3 key signal types.
Okay, what are they?
First, those high-frequency survey releases we mentioned, business sentiment, things like that. Second, critical central bank remarks, especially any specific policy divergence signaling from the BOJ in Japan, and of course that upcoming policy choice from the RBNZ in New Zealand.
And
any fresh trade or geopolitical developments, a new tariff announcement, a security incident, those will have an outsized impact. Basically, we're operating in an environment where soft signaling is temporarily overriding the hard numbers.
Right. So your key watch list then, for you listening over the coming days, really needs to focus on the sources of this uncertainty. First, obviously, the duration of the U.S. shutdown itself. How long does this information vacuum last? Second, any concrete tariff responses from Washington, maybe Beijing or Mexico following that probe.
And third,
any new production guidance from OPEC plus A, and definitely those scheduled central bank decisions, particularly the RBNZ. Those are your kind of temporary anchors in this data-starved world.
good summary.
Now, here's a final provocative thought for you to mull over as you process these pretty unique market drivers right now.
Okay.
Given that these security costs in energy in global freight channels seem sustained, almost permanent features now, even when the headline news is quiet, how much does the market's current reliance on high-frequency business surveys, which really only capture immediate, maybe transient business sentiment, how much does that reliance actually mislead us about the deep, permanent security risk that's now baked into global supply chains?
That's a really good question. Does The short-term focus masks the long-term structural shift.
Something to chew on as you parse the news cycle this week.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.